Yogesh Patil is with us, Chief Investment Officer, Equity at LIC Mutual Fund. Yogesh, good to have you with us here. Thank you very much. Market's down 200. And of course, from the all-time highs, this is a pullback underway, but still a lot of debate whether this is a quick one or there is more here. Would you be a buyer here, Yogesh, or would you let markets consolidate, go sideways, some time correction? What's the sense?
Good morning, everyone. And it's a lot depend on the valuations basically and earning growth. Today there would be temporary setbacks and like in past, but again fundamental will continue to drive the stock specific and sector specific approach. Till now, I completely agree. We reached a valuation point where earning need to perform here, and either earning growth or outlook on earning growth. Because what drives the broader market is basically liquidity, valuations, and earning growth. So valuations have reached the optimal level, liquidity is there, but today earning growth is lagging. So it's a completely sector-specific approach. Maybe we can ignore short-term even global issues, which is temporary in nature. Again, coming to your point, when we make an investment decision, is completely based on so many parameters that includes your interest rates and economic environment and growth available in the sector, basically. If you ask me, today, considering the bond valuation, equity valuations are actually fairly valued. The only thing drive from here is earning growth. If you get earning growth, then only you get a returns from here. So everything is dependent on earning growth and sector outlook from here.
Hi Yogesh, good morning. Good to see you in. So what kind of earnings growth are you penciling in? Most on the street are in mid-teens for the next few years. Do you think that we'll get that?
Yeah, for Nifty, we are expecting roughly double-digit earning growth. But if you see the higher earning growth, we are expecting mid and small cap, where the most of the industry leaders are there. And the kind of capex we see, especially in power, data center, railways, defense, oil and gas, where 90% of our leaders only available in small and mid cap. So we see higher earning growth in small cap because of the capex drive, and there are a lot of changes happened globally. And because of China plus one supply diversification, Indian companies are getting much more business traction, and their addressable market has increased compared to last 5 years. So because of this traction, the earning growth could be higher, and more traction could be in small and mid cap compared to large caps.
Yogesh, I wanted to ask you about these capital market plays. That's been where the big party has been, right? You've seen the only listed exchange, BSE. Even in the unlisted market, you have NSE that's done very, very well. Brokerage firms have done well. Depositories have done well. What's your view currently? Because the equity cult in India will continue to grow from here on. Though some of these stocks have run a little bit ahead of themselves in terms of valuations. Your take?
I completely agree. But we need to also understand, okay, this segment is growing, right? And one should not only look the historical valuations or growth rate of sector. Look at the demat accounts, look at the mutual fund SIPs, and look at the awareness nowadays. It's very much. In fact, if you ask me, considering the F&O volume as a percentage of the cash market, we are actually much more matured now. The only thing is regular, we need to set some discipline so this sector will continue to grow, and most of the investors should look for long term rather than a trader mindset. And there could be a, again, lull period or maybe negative period for some time, but structurally India is heading for a good growth in economy as well as fundamentally, and that will reflect in capital market and participants.
So you'll continue to be bullish on this theme then?
Yeah.
Okay. And which segment, Yogesh, are you? Do you have exposure to without naming names?
Sorry, can't explain. It is a combination of direct, indirect exchanges and broking houses.
Broking houses, got it. No, fair enough. Yogesh, we got numbers. You would have now seen numbers from Dabur, right? It's a bit of a shocker. So what's your view on FMCG? I mean, do you think even two-wheeler sales? I mean, the auto sales for the last month, which came through, it showed a bit of a spike, but looks like there was a fair bit of channel stuffing ahead of the festive season. Actually, if you look at the last, say, 6-7 months, the difference between retail sales and wholesale sales, it's actually quite wide, which means that there is a lot of inventory now in the system. So the next couple of months, perhaps sales numbers drop off. The local market, the India market, not exports. So just your overall view on consumers out there.
Yeah, you're absolutely right in terms of inventory. But again, for let's take automobiles, especially Q2 and Q3, because of lot of changes in festival dates, we should look exactly quarter versus quarter. But I completely agree what's happening, and we need to monitor next 15-20 days. But we should keep a quarterly approach, and especially on FMCG side, we do see some improvement in rural and urban consumption based on so many factors that includes your favorable monsoon, government measures, and increasing wage rates. So last 4 quarter was not very good, and today inflation is coming back, and again growth in the rurals or rural wages also coming up. So we expect some positivity in consumer business, including discretionary and non-discretionary. And at the same time, automobiles, we need to again monitor for 15-20 days would be very crucial for this sector. And we should only take a decision based on quarter, not on month, because month on month is keep changing based on monsoon, based on festivals.
Okay. Yogesh, finally, what is your take on the oil and gas space? Because there's so much going around, oil marketing companies or even upstream companies like ONGC. I mean, how do you take exposure to the energy space, and what's the stance on it? Do you like it at all?
Yeah, definitely. We cannot ignore this space. But again, we would be positive on basically retail companies or maybe gas company compared to a crude company. Because our internal assessment is there would be a oversupply in gas and crude oil for next after maybe 1 or 2 years. So India could be beneficiary. Both we are importing, and that's why we are more positive on distribution side and retailing side here, rather than we see the core commodity like crude oil and gas.
All right, Yogesh, thanks a lot for joining in and filling us in with your take on the markets. Wishing you a good day ahead.